Great. Welcome everyone to another Park Launch session. Um, we figured this time round we'd focus on a theme really centered around growth venture capital. Because I guess to set the context, what you're certainly starting to get, and it's a phenomenon that has already begun to take shape in many of the more mature, what you might call emerging markets in the last 7 or 8 years, which is as companies scale, there's an increasing requirement for investors who can write larger checks as part of growth capital rounds. So the typical phenomenon you see is, informal angel networks evolving, I guess organized early stage funds being created that support regional early stage rounds and activity. And then you see potentially a little bit of a bottleneck, which is as companies start scaling and doing, anything from $30 to $50 million Series B.S.E rounds, you start, and that's typically growth stage, you tend to see fewer players in most regions. Now, obviously, I'm contrasting Western and, in a sense, the VC landscape, because what you'd get, obviously, in Western countries and in the US is a significant scaling of availability of capital at that level and at those sizes of rounds and tickets. And what you typically see is usually either dedicated growth capital players, populated by people who've come out of the banks, for example, or you get, private equity funds who start taking an active look at going into venture and investing into venture. So you'll typically get, the TPGs and the KKRs and Bain Capital and a number of those types of players, who start looking at venture capital or start looking at doing rounds earlier in the value chain. So we've seen that in North America, a lot of dedicated pure play growth players in Europe. And now I think in the last certainly 3 to 4 years, you're starting to see the emergence of, I guess, scaled growth players in the Middle East, a number of people starting growth funds. In Asia, you've probably already seen the phenomenon of larger funds, as I said, either private equity DNA or dedicated VC. And in Latin America, perhaps a similar phenomenon. So one of the things I've noticed, certainly in MENA in the last 2 to 3 years, is a lot of people you talk to have got what they call growth capital strategies centered around writing in the region about $15 to $25 million checks, typically 10 to 20 initially. And then players like STV emerging, which is Saudi Telecom's corporate venture fund, which also has third-party capital, newer capital in the region, early stage fund, and now raising a growth capital fund, and a number of players, obviously, on the sovereign side, doing much larger tickets than typical kind of venture capital funds. So we figured we'd cover a bit of that landscape. And I think given Hassan Chaudhry's experience, it would be great to talk to him, given his origin as a Pakistani, his role as an investor at Morgan Stanley and at BlackRock, and his experiences of contrasting North American growth capital with emerging markets growth capital, and where he sees that heading. We'll talk in a kind of global context, and there are a couple of themes that we're going to draw out. One is, you'll know from the session we did relatively recently between myself and Martin Graham, the IPO preparedness track and exit readiness, and the ability to identify investors who can support the path around creating liquidity and creating value from a public markets perspective. That's a subject we'll cover. And we'll also cover artificial intelligence and how AI is increasingly playing a role, we know, in areas like financial and legal DD. and we'll cover some of the aspects of commercial due diligence also. So great to have Hasan on. I'll welcome him now. If you can just introduce yourself, Hasan, and then we'll start going into questions and elaborating on some of the things I've talked about just now.
Great. Thank you, Ves, and nice to meet everyone, and Assalamu alaikum. So my background, I think Ves touched upon a little bit. Was born and raised in Pakistan, and moved to the US when I was 17, and studied financial engineering at Princeton. Post-grad, I started working at BlackRock, initially doing co-investments and fund of funds, then moved on to doing growth equity investments. Did that for a few years, and then moved on to Morgan Stanley, was part of the growth equity and growth credit platform there. Did that for a couple years, and then just rejoined BlackRock. And I'm part of BlackRock's growth equity team. I know BlackRock's a big place, and there's a lot of capital that BlackRock manages. So I think important to highlight that my team has a few strategies which it focuses upon. So overall, it manages 42 billion in AUM. And then in terms of the strategies, there is the classic fund of fund strategy. We've talked a couple of funds based on Pakistan as part of our fund of fund strategy. It's a global mandate. We invest kind of across the world, India, China, US, Middle East, like kind of everywhere. And then in terms of what we look for on the fund side, it's really looking to drive alpha for our clients, and the clients are sovereign wealth funds, like HKMA, like Japan Post, like big family offices out of the Middle East. And then we're really targeting alpha, targeting a portfolio which has buyout, venture capital, and then middle market buyout. So build a curated portfolio for our LPs. And then on the growth equity side, I focus my time there. So the check size there is from 25 million all the way up to 300 million. The strategy targets Series B to kind of pre-IPO, and again, a global mandate. So we are investors, in companies ranging from ByteDance, which is TikTok, to Acronis, based out of Europe, to OpenAI, which I'm sure everyone has heard of. So it's a very much like a global mandate, and coming in later stage where the product market fit has been built, helping build them out the go-to-market strategy, and helping them institutionalize before they go public. That's a little bit on my background and just like a brief overview of my team.
Fantastic. So tell us a little bit, Hasan, about the geographic aspect, because I think our listeners will be interested in what you're doing in the Middle East, Pakistan, and in other emerging markets, geos.
Yeah. So geographically, I think taking a step back, we have like people on the ground in Saudi Arabia, we have people in Dubai, we have people in Singapore, in Hong Kong, and in London. So we have a pretty big presence there. And then in terms of what we are doing on the ground, I think in the Middle East, frankly, we haven't gotten that close. We actually looked at Kareem, during the venture rounds, but BlackRock really started a presence in the Middle East over the last 5 years. So it's a recent initiative. We have also looked at a few Pakistani startups. We have looked at, I'm sure you're familiar, we looked at Bazaar, we also looked at a couple others. But I think for us, because we play slightly later stage, coming in at the B.C range, most of the startups are slightly earlier stage. So most of the conversations that I've had are more just in terms of like relationship building, so we can get there. I think the other thing I'd like to highlight is just given the wider BlackRock network, we do have a relationship with the state bank where we manage money for the state bank's like forex reserves. So our fixed income team manages that, and then we also manage money for uh like uh for like a set of Saudi investors that invest in the Pakistani stock market. So we have positions in Systems Limited and a few other Pakistani stocks through that. So that's kind of
Got it.
exposure. And then on the fund to fund side, we do have exposure. I think there's a question on the Pakistani startups because we are LPs in a couple of earlier venture funds that have invested in Pakistan. So LPs in Kleiner Perkins. We're also investors in a few other startups, and we have exposure to some of we have exposure to Lightspeed. So through that, we have exposure to Pakistani startups, but not directly.
Understand. And give us a picture, Hasan, on sectoral strategy vis-a-vis core industry verticals.
Yeah, so for us, the core areas of focus, I would say, are fourfold. So it's consumer technology. And within consumer technology, we're really focused upon direct-to-consumer businesses. We target businesses which have solid unit economics, more than $20 million of revenue, and have a moat which kind of differentiates them. So it is more sticky in rate nature. We are very much like quantitative driven investors, so we would look for something that helps differentiate that business from some of the other businesses. We also look for within enterprise software businesses. Within enterprise software, I would say focused on CRM, ERP businesses. So we are big investors in Epicor. We're investors in Visma. And we also look for businesses where you have gross retention above 90%, net retention above 120%, usually backed by a tier one VC in the Series A, B stage, where we can come in at the C, D stage, take a board seat and help institutionalize some of the go-to-market functions and the finance functions. And then within healthcare, we are mostly focused on healthcare tech. So a lot of time has been spent on mental health startups, whether that's Calm or that's some of the other startups that you might be familiar with. So I would say those three, and then the fourth focus has been fintech. So we are investors in Stripe. We are early investors in Klarna. We went in, I think, in 2016. And apart from those four sectors, we have started doing a little bit of deep tech. I personally focus my time on enterprise software and fintech, so I can talk more about that. But within deep tech, we have done SpaceX. So we looked at SpaceX at a 3 billion valuation, then looked at it 30, then looked at it. We invested at a 30 billion valuation, and also just did a small round at 150. They're right now doing around 180. We're also big investors in Sierra Space, which is a general Atlantic portfolio company that did Series B there with GA. So that's kind of I would say, the rough landscape on just globally.
Yeah. And just getting into a little bit of the metrics around, deal flow, etc. I mean, generally across, non-US, how many deals would you look at a year? And just take us through a little bit of I think I'd be interested in your kind of core screening criteria, which obviously is going to perhaps vary by sector. But what are the 3 or 4 characteristics you look for in a good growth deal? And volume-wise, how many do you look at those? How many of those do you look at?
Yeah, both good questions. I think in terms of the volume, we're looking at least 8 to 10,000 deals, and that's not just across growth. But we're looking at also doing co-investments and buyouts. That's the total. Out of that, I would say about roughly 50% are growth equity deals. So that's about 4 to 5,000. And these are later stage deals, so the number would be obviously less than what would be at the C Series A range, just given there are lesser companies at that scale. In terms of the geographical focus, so I'm personally focused on North and South America with some deals that I get on within South Asia, just given my background. But approximately we deploy 50% of capital in the US and 25% in EMEA, so Europe and Middle East, and then the remaining 25% in China and India and Southeast Asia and Australia. So that's kind of been the rough split. To answer the second part of your question, which was on how do we look for what do we look for in an investment? So I think there's some parameters which are just checking the box. If they're not there, then we won't even look at it. So we're looking for businesses with more than $20 million in revenue. We are looking for businesses that have strong unit economics, and we're looking for businesses where we think the founders have embarked upon an idea which we think is, one, mission critical, and two, has the scalability to get us a 3 to 5x return. So in a way, we're almost thinking backward and thinking about, okay, if this company is a $25 million ERP business targeting clients within the Middle East, how can it get from 25 million to a $75 million business? Right now, let's say they had 3 salespeople. What do they need to do in order? How many salespeople they need to hire? What is the quota attainment ratios that they need to achieve in order to get to that $75 million revenue? So a lot of the diligence would be focused upon that, and then looking at the founder, doing reference checks on that. Looking at the unit economics, looking at gross retention, net retention, logo retention. Because I feel like these parameters at the growth stage are usually pretty good barometers for how the company has done historically. And then that combined with a qualitative view on the founder can help us like come up with like a decision on whether we think, in our view, this is a company that can get us a 3x return. And if they can, then we would help them post-investment, hire the right people in order to get to that scale. We would help them, introduce them to the right bankers, help them with corp dev opportunities. So it's a pretty much like an active minority style of investing.
Yeah, got it. And from a, obviously from a post-screening, you've gone to the investment committee, you've done a screening paper, you've got an approval to kind of take a look at a due diligence framework. How do you construct generally the kind of commercial DD hypotheses, and what kind of vendors, partners, experts do you look at normally?
Yeah, so I think our strategy is slightly different from growth because our diligence is very much like almost like a private equity diligence, right? A middle market private equity fund. So post term sheet, we would run like commercial DD, which is usually like a third party like consultant, like a Bain or like one of the other like McKinsey, Bain, BCG ones. We would run a financial due diligence, which at the minimum would be a proof of earnings or audited financial statements. If we have, a shorter timeline, that's the bare minimum. In about 90% situations, we look for a quality of earnings report. And for that, we usually historically have gone to EY. But, we're depending upon the situation, if the company has a good relationship with a vendor, we will go with that. And then for tech diligence, because my personal background actually is I did study financial engineering and wrote my thesis on natural language processing, but most people in my team don't have a tech background, so we will also get a a tech DD report. And then for legal DD, we usually have BlackRock's internal counsel alongside Ropes and Gray, and use kind of a combination of all of those reports in order to come up with what are the 3 to 4 value creation initiatives that we need to build. So oftentimes, even prior to an investment closing, we already know, okay, this CRO is not that strong. This CTO is not that strong. These are the 5 features in the technology tech stack, which we think are tech debt. And we go in and try to update that or present to the company that this is something that we need to do. So that's usually kind of like the third party diligence stuff. I'm happy to give like I think it'd probably be helpful if I give an example so people
Sure.
get it. That's helpful. Yeah, so one of my investments was Scopely. For those who don't know, Scopely is a conglomerate of free-to-play games. So their main game was Star Trek Fleet Command, which did really well. So these were free-to-play consumer games. Anyone could go in, download, and start playing. What got us super interested though was just their dynamic pricing model. In terms of what they were doing was essentially tailoring their pricing according to the customer. So let's say you are software engineering sitting in San Francisco with a lot of time on your hands, and you want to play Star Trek Fleet Command with your friends. So what we started seeing was that there's these customer cohorts at tier 1, tier 2, tier 3. And within the tier 1 customers, we were seeing that there's very much like a lot of stickiness. So a tier 1 customer on average is spending $200 per month on a game. Versus if you compare that to how much money people spend on Netflix or how much money people spend on some of the other subscriber networks, it's usually in the $20, $25 range. And then what they did was they built a portfolio of games. It was almost like an investor would build a portfolio of assets, and we're able to have this long tail of very loyal customers. So an average game usually loses on day one if they have like 1,000 customers, and day 30, a good game would have like 30% left. And on day 365, so a year later, they usually only have like 3 to 5% of customers left. But what Scopely really was differentiated in was that they not only had those 3 to 5%, but on an average, that person spending $200 to $300 a month. So a very sticky core basis of very loyal customers. And on top of that, they were going and buying these other games. So they did like an acquisition in Ireland. They did a few other acquisitions based out of buying game studios in LA. They also partnered with actually a game studio in Pakistan. Um, and using that, they kind of built a portfolio of assets. So in that investment, post term sheet, we did all the third party diligence. We knew what they needed to do in order to go in. So they, in their case, they need to ramp up some of the marketing team. We helped them build out a core dev team and build out like essentially like a list of assets that they wanted to buy, and also were involved in helping them sell the Saudi back route, which they just sold for $5 billion. And that was like a great outcome for us about 6 to 7 months ago. That's like a classic example of what a BlackRock growth equity investment looks like.
Fantastic. And in terms of, structure of how you invest, is it like a kind of evergreen structure, or do you have a typical fund structure?
Yeah, so our pool of capital, I think I mentioned the 42 billion. Out of that, four is essentially for growth. And out of the four, about 50% is a fund. So there's a BlackRock Growth Equity Fund, just like a normal growth equity fund, 5-year investment period, 10-year total term, classic like 220 cycle. And then on top of that, we would have like SMA, so separately managed accounts. So we manage money for state of New Mexico, for example. We manage money for Teachers of Texas. And usually as part of their portfolios, they want to have 20 to 30% exposure to growth. So that would also add in. But for the SMAs, it's usually an evergreen structure in which they kind of roll over their investments whenever there's an exit, and usually it's like a re-up every 3 years. For a fund, we would be in market for BlackRock Growth Equity 2 in a couple of years. So that's kind of the background there.
Understand. And I guess from the perspective of, what's changed in the last 12, 18 months, how has that impacted your investing strategies? Because certainly, and just to give you a picture, and you'll know for sure, but, obviously significant slowdown we've seen globally. And, those kind of headwinds are starting to impact the MENA region a lot more than was the case at the beginning of the year. Beginning of the year, there was a lot of, sovereign kind of deployment driving the ecosystem. That's still happening. I don't think that's changing because, the multipliers and the ADQs and the chimeras and the PIFs in the region here continue to fuel both direct investing, fund of funds investing, and also multiple direct opportunities in the region, especially in Saudi Arabia. But, you're starting to see a fairly major impact in terms of, founders living with down rounds, all the usual characteristics. How have you done from a perspective of both? How has that impacted your perspective on valuation of new deals, and how has it impacted your activity level in existing investments to get a little bit more kind of hands dirty?
Yeah, no, that's a good question. So I feel like numbers speak volumes in those situations. So let's just like shed light on a little bit of numbers here. So, I mean, if you look at where within the enterprise software universe, right, the current median multiple for enterprise software business that's trading on a US stock exchange right now is 6.4x. At the peak, and that's in next 12 months revenue multiple, GAAP revenue multiple, which the company's projecting. At the peak, it was at 16x. So it's down from 16x to 6.4x. Well, and if you look at a 5-year average, it's like almost 6x. If you look at like a 10-year average, it's slightly smaller, it's like 5x. But what we have seen is that quality, to put it simply, businesses, even in this environment, will continue to be valued well. And what does that quality translate into? So that means greater than 30% growth businesses with positive free cash flow. So if you look at greater than 30% businesses with positive free cash flow trading at a median of 9.3 times NTM revenue multiple. But if it's a business's free cash flow negative, it's trading at a median of 4 times revenue multiple. So I think that kind of is the bifurcation. And what we have also seen is a lot of businesses that fundamentally did not have good business models. Essentially, because there was so much money that went in I would say, the longest bull market from 2010 to 2023, you had a lot of newer entrants into the venture capital landscape. So you had, you had big hedge funds that moved in. You had big, like the SoftBanks of the world that were made, right? And what that meant was there's an abundance of capital, and a limited supply of companies that were being made. And so valuations were just completely, delineated from realities. And you had the longest bull market, so there was this idea that you could exit essentially, and take it public. So I think that valuation reset has happened. My personal view is slightly contrarian. Like a lot of people talk about whether it's a hard landing or soft landing. Um, I think this is the new normal, right? I think what we were seeing in 2020 and 2021 was that because you have abundance of capital, you have massive liquidity with, the government injecting trillions of dollars, you essentially had a bubble of spending that just drove valuations up in 2021, 2022 at levels that we had never seen before since the dot-com bubble. And I think that that was a one-time thing. I think this is the new normal. So coming to your second part of the question, which is how do we think about this? I think in the current valuation environment, it is very important as an entrepreneur to kind of prove one that your business model is works. And what does that mean? That means your product is mission critical, right? So in a current environment, if you are able to convince someone to buy a product, it means that your product actually works. And I think some of the best businesses right now are be creating in this environment. Like if you think back, like some of the best businesses, like the Ubers, the Lyfts, the Airbnbs, when were they made? They were really made after the GFC, when a lot of people just put their heads down and thought about what works, what could be the unit economics for such a business model, and really essentially getting their hands dirty and focusing on bootstrapping the business or using whatever limited resources that they have. So I think in a good way, you will have good businesses being formed out of this. But at the same time, I think you will also see a lot of businesses unfortunately go out of business because they fundamentally were bad business models with unit economics that did not make sense. So whenever I meet someone, especially if it's someone from an emerging market or if it's like a Pakistani person, they're looking at raising capital. I think fundamentally the first thing that you should show to an investor is really show the unit economics and show how your business fundamentally makes sense, right? And it's natural that if you're an early stage business, obviously you will be burning money until you get that scalability where you become EBITDA profitable and later you become free cash flow profitable. But understanding and focusing on unit economics, I think is you should always almost do it religiously. And that's step one. For an investor, I think what that means is that there's a valuation disconnect between what entrepreneurs want and what an investor wants. I think it's important to note that most people in the current, like people who are like most entrepreneurs consist of people who have never seen a down market. They've only seen a bull market, which is why when they hear valuations, they fundamentally cannot fathom them. To put that into context with some numbers, about 40% of the rounds that were done this year in 2023 were either down rounds or some sort of a convertible bridge notes. So I think as a founder, if I were to give them advice, I would rather take a down round than think about closing the company and then starting, like if you close the company, like what are your options, right? So I think it's about fundamentally starting to rethink in terms of unit economics instead of growth at all costs. It's about making sure that the investors know that your unit economics make sense. And then thirdly, also just, cutting down costs and getting yourself to a level where you survive. Because I think in our industry, being the survivor is the most important thing. To put that into example, like I was chatting with someone who's in the logistics business, and we're looking at a logistics player within the US. And with Convoy going out of business, there's a lot of opportunity within the US for incumbents who are EBITDA profitable, cash flow profitable to go and buy these businesses. So just by being the sole survivor, you can actually gain market share and capture those businesses. But in order to do that, you have to make some tough decisions, whether that's in form of a RIF or fundamentally questioning whether the business model makes sense. So I think that's
I appreciate that. And from a perspective of where you sit within the round, are you a lead investor, or you're kind of agnostic to that?
Yeah, so we lead rounds in about 50% situations. And in the other 50%, we would come and usually get a call from like an Aitchison or like a Sequoia that we're doing this round. We'll have BlackRock on the cap table because we think the company is going to go public in 3 to 5 years. So I would say in about 50% situations we lead around, and where we do, we usually look for like 1 or 2 board seats and membership of all the committees and like normal governance rights.
Yeah, and from the perspective of obviously a big preoccupation, you talked about bridge rounds and convertibles, which is a pretty common phenomenon now in every region. Investors, founders looking to frankly trade off valuation with just having cash. What would you look at from a Runway perspective in businesses like that? Because you get a lot of companies looking to do a bridge or a convertible. They'll approach players like myself or many of us, including yourself, and they got 2 months' money in the bank and it's looking pretty dire. What's your general view on cash position before you look at a deal?
Yeah, it's funny. I think the current environment reminds me of like I read a lot of Warren Buffett's essays, and it's like be greedy when everyone's scared, essentially, and be scared when everyone else is being greedy. I think in the current environment, you need to at least have 6 months, at least at the very, very minimum, in order to get the terms that you want. Because otherwise, you would get valuations that just don't make sense, right? So at least 6 months and ideally at least a year of runway. I personally think if you take a step back and think about why investment activity has kind of slowed down, it's because most there's a valuation mismatch between what entrepreneurs want and what investors think it's worth. And 2, it's fundamentally people, even in the public markets, you see people not really knowing how to value these businesses because there's just so much uncertainty about what the future status quo would be. So, and everyone has a different perspective on that. My personal perspective is that I think interest rates will start going down in the second half of next year, and we will see increased investment activity in 2024. So I think waiting at the cycle and ensuring that you don't go out of business and having 12 months of runway would give an entrepreneur the best chance in order to raise capital at slightly better terms at that time frame. So a lot of times we are having conversations with our portfolio companies, and the decision that we are trying to make is whether we want to grow at 60 or 70% while burning 20 million, or grow at 30% year on year while burning 5 million. And I think the latter approach is the need of the hour today, because the risk is if you burn 60 million, you would not be able to raise the next round and fundamentally go out of business. But if you raise, if you grow at 30% and burn 5 million, you might be able, if the market interest rates go down in second half of 2024, and people start to deploying more, you might be able to access capital for potentially, fundamentally disruptive M&A opportunity. I think the other thing I also always tell entrepreneurs is you need to think about what the investor wants. Like for us, like we have a 5-year investment period. So we have to deploy in 5 years. And if we cannot, we have to go to our limited partners and request an extension. And even as a limited partner, we are looking to get our capital back in 5 to 7 years. So in a way, investors have to deploy. So like for us, what that has meant in terms of opportunities is we are doing a lot of secondaries. So we did the secondary in Stripe at like the 49 billion valuation. And I think fundamentally it was a very good opportunity for us to get into a company that was last valued at 100 billion. So I think there are these secondary opportunities. I think in the current environment, yes, an entrepreneur might give slightly more to the investor, just in terms of like the negotiating table. But I think long term, it's about survival and just staying in the game and making sure that you can capture market share, because not everyone will be making the right decisions, and you should be the one making them, and really capturing on this, uh, essentially capturing on market share in this environment.
Yeah, and from the perspective of founder, so because most of the businesses you invest in will still be generally founder led in general, with by then a pretty strong core team of seasoned operators, sector type guys who've been there, done it. So the C levels in place, the founders typically there for the whole journey so far. What are the top 2 or 3 characteristics that you think have been most common features that you've seen in great founders?
That's a great question. So in 2018, when I was like a new investor, I got on the phone with Elon while he was raising like his next round for SpaceX. And the few things that I think differentiate like a good founder from like a normal founder. One is just the ability to execute at all costs, right? A lot of founders, there are a lot of CEOs, founder CEOs who I feel like have a great idea, but completely miss the ball when it comes to execution. And what does that mean? I think it's about thinking about the business at all times, thinking about what is needed in order to get there. And I think there's a steep learning curve, especially for first time founders, in terms of understanding that. So, in order to get there, they need to have the right problem solving skills, but they also need to be able to leverage their venture capital network and their growth equity investor network to raise their hand and tell us when they need help, right? And so the way we personally do that is like we partner our portfolio company CEOs with other portfolio company CEOs, because the CEO job in its essence is pretty lonely, right? It's like you have to make some tough decisions and you need to consult someone. So I think partnering with the right venture capital, right growth equity investor allows you to make those right decisions and also get the resources that you need in order to make the right decisions. So I think having the curiosity, the ability to execute are two. And then the third thing that I personally find, uh, I think that differentiates great entrepreneurs from like I would say good entrepreneurs is that they lead from the front. I know it sounds very cliched and hackneyed, but I have met so many founders who might work very hard in terms of building the C-suite in the year 1 or year 2, but year 3 or 4 they're extremely reliant on their CRO to like go and like drive the sales. I think founders who lead from the front, like that's an attribute that I really admire about Elon is like, he is the person who probably knows the most in the room, even when he is scientist. So like an example was when we were looking at Starlink back in 2018, and we had a question about the physics of Starlink. Like Elon did not turn to like another scientist or anything. Like he himself answered all the questions. When he had a question on valuation, he did not turn to a CFO, but like he answered that himself. And I think understanding that at the end of it, you have to lead from the front. You are the leader. You have to set an example for all your employees. I think it's very important, right? It's like it reminds me of the English adage, like when the cook is away, like I'm blank on the adage, but essentially you have to be there, right? If you are not there, that it's hard to motivate the team, and people need to believe in the idea. Like you have to be there, you have to motivate the team and believe from the front.
Yeah, and we just had COP28 in the UAE. And I think you'll start to see the emergence of climate tech as a vertical theme in many funds. There's a question that came up earlier around eco-friendly businesses. I'd love to expand that into a more general kind of discussion around environmental, sustainable types of values and climate tech. So how do you see that? I mean, do you see sustainability and environmental ESG type drivers as intrinsic to the deals you do? Or do you see alongside that a potential for you to start looking really at new verticals and climate tech as one example?
Yeah. So as part of like BlackRock's kind of ESG initiative, we have
Yeah.
we actually have like an impact fund within our team as well. So we do a lot of, and within the impact fund, we focus on the 5 SDGs. We would focus on climate, we would focus on health and wellness, we would focus on financial inclusion, uh, and we focus on healthcare, and then we also focus on diversity. So climate tech is definitely a big focus for every investment that we do. In terms of the teams at COP28, I think the biggest team was just in terms of transition. And there's another BlackRock initiative, which is Transition Capital, which is a fund, which is a like a joint venture between BlackRock and Temasek. Temasek's the Singaporean sovereign wealth fund, and the idea is to back businesses that essentially are investing in carbon transition, um, and helping back these businesses get to the next step. I think to answer your question directly on the teams, like for us, when we think about impact, we think about the SDGs, but we also think about it in terms of the financial element of it and making a return. So from a COP28 perspective, I think there's a lot of interesting things that are happening in carbon transition, whether if you look at the battery space, you historically had NCM batteries and people are switching to LFP, LFP plus. I think solid state batteries would also be helpful in reducing the carbon footprint. I think there's a lot of startups that have come around which are just playing within the carbon credit space. And I think a lot of businesses, especially industrial businesses that I'm seeing, are beginning to track their carbon footprint, just given that there is a financial element to buying and selling these carbon credits. So I think that's one. I think the second thing is just in terms of like energy transition. My personal view is that with the Inflation Reduction Act, and with all the tailwinds towards essentially with all the tailwinds towards clean energy, we're going to see more and more use of electric cars and more use of like I would say environmental friendly batteries. So going back into it, NCM, you have nickel, which is mined and has some ESG concerns. We're moving that there to like LFP and then LFP plus, which Mujib, who's I know has also been on on park launches events, companies like One Battery being formed. And then you have solid state battery companies such as Sectoral, which are being formed, which would fundamentally transform this business with higher range and a lower carbon footprint. So I think that's pretty interesting. Um, and I know it's a big area of focus for BlackRock. I personally haven't spent too much time there, so that's battery is really I would say the limit of where I spend most of my time.
Yeah, and from a diversity perspective, one of the questions has just come in around, how does diversity feature as a team and founder kind of filter in terms of, is it a focus area or how do you look at it?
Yeah. So I think from a diversity perspective, there's another initiative within BlackRock, which is called BlackRock Impact Opportunities Fund. There's a $1 billion fund, which is buyout, and is focused on essentially backing entrepreneurs from diverse backgrounds. What that means is people who are Hispanic or African American or come from Native American backgrounds. Um, I think the strategy, I think going back to the climate perspective, it's similar that you are focused on the cohort of businesses that are led by diverse entrepreneurs. And the reason is that, I think at the end of the day, a lot of when as an entrepreneur you go out and pitch to an investor, right? A lot of it is based upon your networks, like the investors that you're going to or the advice that you get. So oftentimes you see underrepresented founders missing out, like people missing out on underrepresented founders and missing out on great investments. So that's the area of focus there. So we look for businesses which are either majority owned or have a co-founder who's a diverse entrepreneur. And then I would say the remaining investment strategy is very similar to how it would be for a normal growth equity deal. I would like to highlight though, there's funds out there within Morgan Stanley. There's an impact opportunity fund as well, and then there's diverse funds as well. What we have seen actually is, and what people don't realize is the business element to it. Like, you can actually make a lot of money from like backing businesses were run by people who fundamentally were not getting that opportunity because they didn't go to a school where they had the right opportunity set, or they did not have the right network in order to access that capital. So what we are seeing is some outperformance. So like, for example, if it's like a bunch of Planet Fitnesses which are run by some African American person who's just a great administrator and is able to kind of essentially manage his capex pretty well, help grow the store footprint, uh, have the right financial engineering in place and able to sell it and make a 3 to 5x return, or it's some other enterprise software business that's run by a diverse founder. I think the strategy, in essence, helps you to kind of diversify and target people who otherwise would not get the capital. But it's still
Understand.
about like making like a 3 to 5x return.
Yeah. A couple of questions have come in, and I'll answer. One or two of them I could probably answer before you even have to look at them. Do you invest in prototype pre-seed? The answer is I'm sure not, because obviously by definition the stage of your investment is clear. From the perspective of a market like Pakistan, so broadly speaking, get the North American aspect, get the selective Middle Eastern aspect, heavy focus Latin America, South America, get that completely. I'm sure you probably have a constructive, positive view about the Asian markets. We've seen a lot of growth, positive growth opportunities in Singaporean, Indonesian businesses. So I'm sure you've had a piece of some of that. But from a Pakistan perspective, obviously, historically, obviously it's a maturing venture capital market and industry. A lot of enablement has happened. A lot of domestic and regional capital has gone in, selectively some international US capital. What do you think is the house view at BlackRock in a market like Pakistan, and what can you do, I guess, as a Pakistani diaspora individual to positively influence that perspective?
Yeah. So I think back in late 2021, early 2022, like there was a BlackRock webinar in Pakistan for all the BlackRock investors. And in late 2021, when you had, the epitome of like venture capital and funding kind of flowing in, but that was like a 85 million round in airlift or, bazaar raising capital, everyone was super optimistic and there was general sense within the team to, like find out what could be the next big thing. I think in Pakistan, like the macro environment, whenever I chat with someone, whether it's for, like an off the line angel investment someone's considering, or it's like institutional investor thinking about putting in their money, I think the macro makes a lot of sense. I think Pakistan, the problem fundamentally has been a lack of political stability, and I would say a lack of um, just a lack of professionalism on part of like the way some entrepreneurs have handled things, which I think have burned some of the investors in the valley in terms of like investing in the region. Because if you think from a venture capital perspective, a lot of these investors want liquidity, right? And in Pakistan, when someone like a VC is investing, there aren't that many exits. So the question becomes, okay, how are you going to exit? So it's very good to see that the Kareem acquisition, closed down. And I think the macro opportunity makes a lot of sense, but I think we need to have a lot more exits, whether that is a public market exit, and that's probably a wider conversation which can warrant another like webinar, or it's just building out that ecosystem in terms of selling to strategics and having the right investors on the board is also pretty helpful because they can introduce you to the right investment bankers based out of London or Middle East who can then run a sale process to, a Middle Eastern conglomerate or like international conglomerate. Because I think there's a lot of optimism within the investor side in terms of like investing and capturing on their digitalization of the Pakistani ecosystem. It's just about having those entrepreneurs who can execute, and I think a lot of good work has gone in, and I think the level of professionalism has gone up. Like, and I've met a lot of these entrepreneurs, and I think they're very smart people. I think it's about continuing that because the bar is higher. Just given if a U.S. investor is investing in Pakistan, they're looking for a 5 to 700 bips outperformance from a U.S. investment, and that would mean like if they're investing in a Pakistani company, they're looking for a 3 to 4x instead of a 2 to 3x. So I think as an entrepreneur, unfortunately, the bar becomes slightly higher in terms of being like, okay, this is what we can do, and which is why I think partnering with top tier investors and top tier VCs can be very helpful. I also tell people, a lot of times people start comping to various other markets and expanding into like regions, like outside of the Pakistan. Like the idea is like we do in Pakistan for a year, then expand to Saudi Arabia for like the next year and stuff. I think really building out and showing the go-to-market in Pakistan is also very important, because Pakistan in itself uh, is a pretty big economy. I've seen that a lot in Mexican startups, essentially. That what they do is like they first, like I was talking to a fintech player within Mexico, and they just focused on building as like a point of sales platform within Mexico, and they were just focused on like having their point of sales terminals at different Mexican retailers, like the Mexican version of Cariana stores and stuff, and building out that ecosystem. And then the next step there was to get their digital banking license and build it out, be into like grow essentially horizontally, but within Pakistan. And once you have kind of established your presence as a market leader in Pakistan, then making the leap and then expanding to the Middle East. And I think unfortunately it's just become like people try to sometimes do too many things, and you end up like not really focusing upon anything in particular. But overall, I think I'm pretty bullish in Pakistan. I think that like I've done some angel investments as well, and like I think the Pakistani ecosystem, what we if we can get some stability in our ecosystem, whether it's form of currency or it's political stability, I think the ecosystem is ripe for disruption, inshallah. And like we've already seen that in India, right? Take fintech for example. Paytm in India was doing like zero or like less than $1 billion in transaction volumes in 2016. Paytm right now is doing about $8 to $10 billion in revenue with more than $100 billion in transaction revenue. Like, and I think we are starting to see that in Pakistan with Rast and stuff, but it's still pretty early stage. And hopefully, people can capitalize on that and inshallah, like expand that ecosystem, because we love to see more Pakistani startups at the Series B.C level and help back them, but it's just not been the case. I think we're still early in our ecosystem.
Yeah, a couple of questions before we wrap up, I think, which were on our, initial discussions over the last week. One was around IPO preparedness, and as you look at growth capital opportunities, how does IPO exit feature as an early discussion with a founder, and what do you do to build that kind of discussion and bake it into an ongoing board engagement? Because you're investing in companies that might well go public over certainly 3 to 5 years, if not around, I guess 3 to 4 years in general. We know IPO fever is there in the MENA region, but we also know that it's in more of a downturn mode, perhaps in Western markets and in the US. And we also know that exit is the single biggest challenge, from my experience, facing companies. Raising money is hard, I've always found. Exiting is really hard, I've found as well. And identifying good deals is relatively easier than the other two things I mentioned. So number one, let's talk about IPO. And then we also discussed earlier in the week around AI. And, let's look at it from two perspectives. AI in terms of how it features in the value plan of companies you look at, and AI, how it features in due diligence and fund specific process.
Yeah. So IPO readiness, I think people really underestimate the value of a good banker. Like I was following some of the privatization initiatives that are happening in Pakistan, and just thinking about like which bankers are getting hired to privatize some of the state-owned entities. But it's very important to have a banker. Like the example I tell people is like if you have a plot in like DHA Phase 5 in Lahore and you want to sell it, you want to have the highest price, right? And in order to get the highest price, you need to have a good broker, right? if you go to like a real good like property dealer, you would get the highest price. Similarly, as like a bank is kind of like similar. Like you really want to have those banking relationships with the Morgan Stanleys, with the Goldman Sachs, with the JP Morgans of the world, and help them like lead in mandate for your company in order to run the IPO. I think that's one very important. Two, I think I've seen a lot of businesses, I would say IPO early, especially like with the SPAC market, like with Swivel, right? For example, like you saw like go public and then the stock price is completely craters. I think it's very important to have the right scale when you IPO. So for a business in the MENA region, I would say I think the bar is usually at least 150 million of revenue. If you're like an enterprise software business with 100 million of revenue, I think you can go public. Because when you want to go public, you want to make sure that like you get the right reception from the biggest institutional investors. So these institutional investors are BlackRock. They represent big mutual funds, they're big sovereign wealth funds, and having a good roadshow becomes very important. So I think a lot of people have the allure of going public, but I think being patient and getting your company to that scale is way more important long term for a business than going public early, stock market price potentially cratering, and then facing like a delisting. So I think businesses just focus upon growth at revenue and get to that like 100 million mark. And once you're at that mark, start talking to these bankers and developing relationships. There's enough people in the diaspora in these banks, I think now, where you can kind of use them to kind of like help and like develop relationship people. Like I know personally know like a bunch of people who are top tier bankers who have Pakistani descent and who want to give back. And I think from their standpoint, like you should listen to their advice on what the right time is to go public. The second question on AI, it's a pretty long conversation. I know we were short on time, but my own perspective here is that we have been pretty active within the infrastructure layer. We haven't invested anything within the application layer. On the infrastructure layer, I think I mentioned OpenAI was one. We've also looked at a few others. I think at the infrastructure layer, you have a few interesting players. You have the Midjourneys, you have OpenAI, you have the Anthropic. So it's about the model and having a robust model. I think there's a lot of opportunity within the application layer, but I also think there's a lot of hype right now. And what hype leads to usually is that people end up deploying a lot of capital and then kind of going back to what happened in 2019, 20, you might see some application businesses which are not fundamentally feasible. I think the other thing that I like to highlight with ChatGPT 4 just being so cheap is that the balance of power, I think, actually is going to shift back to the incumbent. So you're going to see a lot of large MNCs, which historically were slow, start to incorporate AI into their business models. And we're already seeing that, right? Like, for example, we're seeing like big trucking businesses incorporating ChatGPT 4 in order to make predictive analytics, which usually would not happen. Like for example, like if you look at Microsoft and how Microsoft Copilot has just essentially ballooned from zero to like more than $1 billion in ARR, I think that speaks volume. So I think in the balance of power actually is going to shift to incumbents. But I also think for Pakistani businesses, there's a great opportunity, especially within the services side, but also I think it evens it out, just given that the cost of labor in Pakistan is cheaper. So a lot of Pakistani businesses can start incorporating AI and offer these services to US businesses. But I have a slightly contrarian view. I personally think it's going to shift the power back to incumbents with all these LLMs. Um, I think the infrastructure layer is where you are playing, which is the safest. I think on the application layer, I'm slightly less bullish on. But that's my 2-minute answer.
Fantastic, great. And we're exactly on time. We're at 1 a.m. where I am, but I really appreciate your time. There was one question at the end, which was how can community members at Park Launch get in touch with you, and would that be possible?
Sure. Yeah, my email I think is on my LinkedIn, and would love to kind of be in touch with people who want to reach out to me. So I think email would be the best way.
Fantastic, great. Really appreciate your time, and we look forward to even in due course doing a follow-up, Hasan. So great getting that perspective from a blue chip US institutional name. and how you see the world and how you see growth capital in many of the geographies that we are in and invest in. So really look forward to talking to you again and look forward to engaging with the rest of the community. We've had a pretty good turnout of people on this webinar. I'm sure it'll get posted in due course. So appreciate everybody's interest and appreciate your time.
Thank you, Wes. Appreciate you jumping on to help here. Thank you, everyone. Inshallah, we'll do more.
Great stuff. Thank you. Fabulous. Thank you.